Las Vegas is posting record construction numbers, packed hotels, and billion-dollar developments. Headlines scream economic boom and unprecedented growth. But what if I told you this prosperity is completely fake? What if every glowing statistic masks a financial disaster that has already begun? The math does not add up, the debt is staggering, and the warning signs are everywhere if you know where to look. In this video, I will expose the economic house of cards disguised as a Las Vegas renaissance and show you why this artificial boom is about to become a devastating collapse. The question is, when the facade finally crumbles, who is going to be left holding the bill? Let me show you how they are manufacturing prosperity out of thin air. Driving down the Las Vegas Strip today, you are bombarded with visual evidence of what appears to be an unprecedented economic boom. Construction cranes dot the skyline as far as the eye can see, with an estimated $40 billion in new development projects currently underway. The sphere glows magnificently at night, drawing thousands of tourists for selfies alone. The Raiders Stadium stands as a monument to the city's new status as a Major League sports destination. And if you believe the headlines, hotel occupancy rates are nearing pre-pandemic records, with weekend rates often exceeding $500 per night for standard rooms. On paper, Las Vegas looks unstoppable. Property values have soared over 40% since 2020. Tax revenue is up. Employment numbers appear strong. Tourism officials boast about record visitor numbers returning to the city. It is the Vegas Renaissance we have all been waiting for, except it is not real. Look beyond the glossy press releases and corporate earnings calls, and you find the disturbing truth. While visitor numbers have recovered, per visitor spending on gambling, the lifeblood of Vegas, has been in steady decline for 5 consecutive quarters. The average tourist now spends 22% less on the casino floor than they did in 2019. Repeat visitation, the most reliable indicator of sustainable tourism, has plummeted to a 15-year low. Local wages have remained nearly flat despite skyrocketing costs. What we are witnessing is not organic economic growth. It is a carefully orchestrated financial illusion designed to mask fundamental economic decay. The prosperity is not being generated by sustainable business practices. It is being manufactured through unprecedented debt, foreign cash infusions, and accounting sleight of hand. But here is the smoking gun that proves this prosperity is manufactured. The evidence is not hidden. It is in their own financial filings. Let me walk you through the timeline of how this artificial growth machine was built, using the corporation's own numbers against them. In late 2019, just before the pandemic, major casino corporations began an unprecedented borrowing spree that would eventually total over $47 billion in new debt. This was not just emergency pandemic funding. This continued well after reopening. MGM Resorts, Caesars Entertainment, and Las Vegas Sands collectively increased their long-term debt obligations by over 60% between 2019 and 2022, despite revenue that had not returned to pre-pandemic levels. By 2020, as Vegas was still reeling from shutdowns, something peculiar happened. Foreign investment funds, primarily from Asia, the Middle East, and Europe, poured an astonishing $23 billion into Vegas projects. This happened despite tourism being at historic lows and future projections showing concerning trends. The Fontainebleau, sitting unfinished for over a decade, suddenly received full funding. New casino projects broke ground despite saturated market conditions. The question nobody seemed to ask was, why would international money flood into Vegas during its darkest hour? By 2021, corporate financial reports began showing concerning patterns. Revenue per available room, a key hotel metric, remained below 2019 levels. Yet companies reported increased profitability. How did they do it? Through aggressive cost-cutting measures that significantly reduced service quality, while maintaining or increasing prices. Staffing levels were slashed by roughly 20% across major properties, with remaining employees covering multiple roles. This was not efficiency. It was desperation disguised as innovation. Then in 2022, we saw the construction boom kick into overdrive, funded almost entirely by borrowed money. The Fontainebleau, Resorts World, Durango Casino, Dream Hotel, and MSG Sphere All represented billions in development at a time when customer metrics were actually declining. Corporate debt to EBITDA ratios, which measure a company's ability to pay its obligations, exceeded 7 to 1 for multiple major players. Those levels are typically considered extremely risky by financial analysts. By 2023, these debt-to-revenue ratios reached what many financial experts privately called unsustainable territory. Yet the expansion continued unabated. Fourth quarter earnings calls revealed that major Las Vegas corporations were spending up to 40% of their revenue solely on interest payments, an unprecedented figure that would be financial suicide in any normal business environment. So what is driving this financial suicide mission? They are not building for the future. They are building to cash out. This is not about long-term growth. It is about creating the impression of value to maximize exit prices. Let us examine who is really behind this artificial boom. Major private equity firms have systematically acquired controlling interests in Vegas properties over the past 5 years. These are not long-term investors. They are financial engineers with a proven history of loading companies with debt, extracting maximum value, then selling or bankrupting the hollowed-out remains. The executives running major Vegas corporations know the current business model is dying. Gambling revenue has been declining steadily as a percentage of total revenue for over a decade. Younger generations simply do not gamble at the rates their parents did. The solution is to create a massive construction boom that inflates asset values in the short term, drive up stock prices through financial engineering rather than actual business growth, cash out stock options worth hundreds of millions, and then leave before the inevitable collapse. Foreign investors, particularly from China and the Middle East, have been sold a romanticized Vegas fantasy that bears little resemblance to economic reality. They are pouring billions into projects based on outdated tourist projections and inflated revenue forecasts. By the time they realize the actual return on investment will be a fraction of what was promised, the developers who pocketed the funding will be long gone. This is not sustainable growth. It is a controlled wealth extraction operation designed to concentrate billions in the hands of executives and private equity before the inevitable bankruptcy restructurings wipe out other shareholders, employees, and the local economy. And the people, they're starting to see through the lies. Locals and tourists alike are calling out the fake prosperity. Talk to actual Las Vegas residents, and you will hear a very different story than the one being promoted in economic development brochures. Housing costs have surged over 70% since 2020, while local wages have increased just 12% during the same period. The resulting affordability crisis has forced thousands of service workers to live in extended stay motels or commute from increasingly distant suburbs. A casino cocktail server I interviewed last month told me her rent has doubled in 3 years, while her base pay has increased by just $2 per hour. She said the city is called a boom, but the only thing booming is how fast her tips disappear on basic needs. Tourists are sharing their shock at what Vegas now costs. A weekend trip that might have cost $1,200 for a couple in 2019 now easily exceeds $2,500 when factoring in resort fees, parking charges, inflated food prices, and ticket costs. Social media is filled with visitors lamenting the decline in service quality coupled with skyrocketing prices. The phrase "Vegas isn't worth it anymore" appears with increasing frequency in online reviews. Small business owners throughout the Vegas Valley report being systematically priced out by artificial real estate inflation. Commercial rents have increased by an average of 35% since 2020, forcing hundreds of local establishments to close. They are being replaced by corporate chain operations with deep enough pockets to absorb the inflated costs, at least temporarily. Even mainstream financial media has begun questioning the sustainability of Vegas growth. A recent Wall Street Journal analysis highlighted that the current construction boom is occurring despite gambling revenue per visitor trending downward for 15 consecutive months. CNBC called the debt levels of major Vegas casino corporations concerning and potentially unsustainable in a normal interest rate environment. But what we are seeing now is just the beginning of something catastrophic. This house of cards is about to take down more than just Vegas. The artificial boom has created a debt bubble that will devastate Nevada's entire economy. Here is what the collapse will look like. As tourist spending fails to meet projections necessary to service the massive debt loads, companies will face critical cash flow shortages. Interest payments will consume an ever larger percentage of revenue until operations become mathematically unsustainable. The initial response will be further service cuts and price increases, accelerating the decline in visitor satisfaction and repeat business. When quarterly numbers cannot be masked anymore, we will see the first wave of project abandonments. Construction will halt on half-finished developments, creating modern ruins alongside the Strip, just like we saw after the 2008 financial crisis, but on a much larger scale. Foreign investors, realizing they have been sold unrealistic projections, will demand their capital back, only to discover it has been spent. The job losses will be staggering. Construction will collapse first, eliminating thousands of positions virtually overnight. As financial pressure mounts on operating properties, we will see mass layoffs that will make pandemic cuts look modest by comparison. Between direct casino employment and supporting industries, as many as 100,000 jobs could disappear from the Vegas Valley. The housing market, artificially inflated by the construction boom and investor speculation, will experience price drops of 30 to 50% in premium areas. Thousands of mortgages will slip underwater, triggering a foreclosure crisis similar to 2008, but concentrated in Nevada's already fragile economy. State finances, heavily dependent on gaming tax revenue, will face immediate shortfalls in the hundreds of millions of dollars. Essential services will be cut. Infrastructure projects will be abandoned. Schools, already among the nation's worst funded, will face devastating budget reductions. This will not be a normal market correction. This will be an economic catastrophe disguised as an inevitable downturn. The difference is crucial. Market corrections happen naturally, but catastrophes happen when systemic deception finally collapses under its own weight. So how do you protect yourself from this inevitable disaster? The collapse is coming, but you can still protect yourself. First, recognize the warning signs for what they are. When you see a $2 billion casino break ground in a market with declining gambling revenue per visitor, that is not optimism. That is financial engineering. If you are an investor, avoid Vegas-related investments like the plague. Casino stocks, tourism-dependent businesses, and especially Nevada commercial real estate are all poised for significant devaluations when reality finally catches up to the manufactured narrative. The smart money is already quietly exiting these positions. If you work in the Vegas hospitality industry, develop exit strategies and transferable skills now. The jobs that seem secure today will be extremely vulnerable when the financial day of reckoning arrives. Build emergency savings and reduce debt while you still can. If you are considering buying property in the Vegas Valley, wait. The current prices are artificially inflated by the construction boom and speculative investment. When the music stops, you do not want to be the one who just paid peak prices before a 40% correction. As a consumer, stop funding the illusion by choosing more sustainable destinations for your travel dollars. The value proposition in Vegas has deteriorated dramatically as corporations extract maximum short-term profit at the expense of the customer experience. Your tourist dollars are literally fueling an economic Ponzi scheme. When the crash comes, and it will come, those who prepared will survive, while those who believe the fake prosperity will lose everything. The warning signs could not be clearer. The mathematics could not be more straightforward. What we are witnessing in Vegas is not sustainable growth. It is the final stage of wealth extraction before an inevitable economic collapse. They've been lying to you about Vegas prosperity while building their own escape plan. Have you noticed the artificial inflation destroying real value? Share your Vegas expense horror stories below. We're exposing this together. Subscribe if you want the truth about these corporate scams before they collapse.